Welcome to this session of our course on Financial Institutions and Market. I am Dr. Sonam Bhadoria, Assistant Professor at Swami Rama Himalayan University. In today's lecture, we will dive into one of the most fundamental components of capital market, which is equity shares. Whether you are an aspiring investor, a finance student, or a budding entrepreneur, understanding equity shares is crucial for everybody. Equity shares not only represent ownership in a company but also lie at the heart of wealth creation and corporate governance. Today, we will explore what equity shares are, what they represent, what are their key features, and why they are so important to both the companies as well as the investor. So let's start with the very basic question: what exactly are equity shares? So let's see. Equity shares, also known as ordinary shares, represent ownership in a company. When an individual or institution buys equity shares of a company, they essentially become a part owner of that particular company. This ownership entitles them to a portion of the company's profit, usually in the form of dividends, and also gives them the right to vote on important company matters such as the election of the board of directors or the approval of any significant corporate decisions. In the return, shareholders also assume a proportionate share of the company's risk. If the company does well, shareholders benefit from the capital appreciation and the dividend, but it performs poorly, these are the only shareholders who may suffer a decline in the value of their holdings or may even lose their investments entirely. Now, what are the companies who issued the equity shares, or we can say the equity shares are issued by companies to raise long-term capitals from the public. This capital is used for various purposes such as setting up operations, expanding businesses, funding innovations, or even repaying the debts of the company. The issuance of equity shares take place through the primary market only, often by an initial public offering, which is commonly known as IPO. It is not a new term for anybody. Once the shares are issued and allotted to investors, they are listed on stock exchanges where they can be freely traded in the secondary market. These exchanges provide a platform for investors to buy and sell shares, and the prices fluctuate based on the market demand, company performance, industry developments, and the overall macroeconomic conditions. One of the most defining characteristics of equity shares is that they are non-redeemable, which means like debentures or preference shares, equity shares do not have a fixed maturity date because they are associated with the ownership of the company, and the ownership is always forever. The capital invested in equity shares remains with the company unless the company is liquidated. Shareholders can exit their investment by selling their shares in the open market, but the company is not obligated to return the invested capital. This makes equity capital a permanent source of finance for the company, giving it long-term stability. Now, another key feature of equity shares is that the residual nature of their claims, which means the equity shareholders are the last to be paid in the case of company is liquidated. As you know, the secured creditors to whom the company is paid, then the unsecured creditors and the preference shareholders. Whatever remains after all the obligations have been made is distributed among equity shareholders. This makes the equity shares relatively little more risky, but at the same time they offer the highest potential for returns also. If the company grows and becomes highly profitable, equity shareholders earns the maximum return in compared to other credit worthies, and it benefits most in the terms of both capital appreciation as well as dividends. Now, the another important aspect of equity shares, what is this? It is the voting rights. Voting rights are an important aspect of equity shareholding. Each equity share generally carries one vote, allowing shareholders to influence corporate policies and the decisions. The power to vote enables shareholders to elect the board of directors, approve mergers and acquisitions, amend articles of association, and make other strategic decisions. In this way, equity shareholders have a direct say in the governance of the company. This aligns the interest of management with those of the owners and introduces a system of checks and balances. Now, let's talk about how equity shareholders earn returns. As we discussed, the returns are maximum associated with the equity shareholders. So, the first source of return is dividends. Dividends, as we know, are a portion of the company's profits distributed to shareholders, usually on an annual or interim basis. However, it is important to note here that the dividend payment is not obligatory. The company's board of directors decides whether to pay a dividend or not and how much. That totally depends or based on the profits, future investment needs and the overall financial health of the company. Then the second and often the more significant source of return is capital appreciation. When a company performs well and its earnings grow, the market value of its shares typically rises. This leads to a gain for shareholders if they sell their shares at a price higher than the purchase price. So, this is the way how equity shares earn profit or return. Now, the most important characteristics of equity share is liquidity. They are characterized by high liquidity. Since they are traded on stock exchanges, shareholders can easily convert their investments into cash. This makes equity shares an attractive option for investors looking for flexibility. Additionally, investing in equities allows for portfolio diversification as shares can be bought across sectors, industries and even geographies depending on the investor strategy only from where he wants to purchase the share. Now, So let's discuss about the higher potential returns comes higher risk. As we know the basic principle of the finance, high risk, high return. Equity shares are subject to market volatility. Their prices can fluctuate significantly due to factors like changes in government policy, macroeconomic conditions like interest rates, inflation, geopolitical tensions, and even investor sentiments. Moreover, company specific factors like poor earnings, management issues, or regulatory penalties can severely impact share prices. Therefore, investors must carefully assess their risk tolerance and investment objectives before investing in equity shares. So, let me give you a practical example. Suppose you purchase 100 shares of a company of rupees 500 each, investing rupees 50,000 in total. Over the next year, the company posts strong earnings, introduces a popular new product, and gains market share. As a result, the stock price rises to rupees 750 per share. If you choose to sell your shares at this point, your investment would be worth rupees 75,000, giving you a capital gain of rupees 25,000. Think additionally, if the company had declared a dividend of rupees 10 per share during the year, and you would have also received rupees 1,000 in dividend income. This demonstrates how equity shares can generate both income as well as the growth for the investors. Then let's talk about the companies, how the equity financing the companies, which means for companies, equity financing through share issuance has its own advantages. What are they? It does not create a repayment obligation as in the case of loans or debentures. As we discussed, the capital doesn't supposed to be back anytime. There is no interest burden and the capital can be used with greater freedom. It also enhances the credit worthiness of the company as a stronger equity base can support more borrowings if the company required. So, however, it also dilutes ownership and control of the company. Issuing more shares means bringing more owners who will have voting rights also, and they will share the profit in future always. So, if we talk about the concept of equity shares in Indian context, in the Indian context, the shares, the equity shares are regulated by Securities and Exchange Board of India, or we know that SEBI. SEBI lays down rules and guidelines for public offerings, listing requirements, disclosure norms, and protection of investors' interest. Stock exchanges like the Bombay Stock Exchange and the National Stock Exchange provide platforms for trading in equity shares. In recent years, increased digitization, the rise of online trading platforms has also increased, and the growing financial literacy among the people have significantly boosted participation in the equity market, especially if we talk about the retail or the individual investors. So, let's summarize today's session by highlighting the points like equity shares represent ownership in a company and entitle shareholders to a share of the profits and voting rights in the corporate decisions. These shares are issued to raise long-term capital, trades on stock exchanges, and it provides returns through dividends and the capital appreciation. While these shares carry higher risk due to price volatility and the business uncertainties, they also offer the highest potential for returns also among all the financial instruments. Equity shares are central to wealth creation, corporate governance, and the overall development of the economy. As we conclude this session, I encourage you to reflect on how the factors like the investors consider before buying equity shares, or what should be a thought process of an investor before buying any equity share. How does equity financing impact a company's financial structure and decision making? And finally, how can retail investors build a diversified equity portfolio that balances risk and return? Thank you for joining me in this session on equity shares. What is the meaning of the equity shares and what are the features of equity shares? In the next lecture, we will learn about dematerialization process and the investor accounts. Until then, stay curious, stay informed, and continue building your understanding of financial markets. Thank you. Namaste.